Chapter 2, Property. Now that you understand the basics of what a will is and what it's needed for, you also need to understand property, which is the basis of what a will is used for. Now, property is anything that can be owned. Thus, it can be classified as real property, or personal property, or intangible property. Real property is property essentially that cannot be moved. Examples can be land, airspace, buildings and other structures, or fixtures. Fixtures are things that are attached to land. So, obviously something such as a house or a building clearly becomes part of the land and is thus real property. But what about things like flooring, or speakers wired into the walls, a basketball hoop on the roof of a garage, a grandfather clock, or other lighting fixtures? Are those part of the real property, or are they personal property that can be moved? Most of these examples in real estate would be considered real property. The exception could be something like a grandfather clock or things that can be easily removed. But flooring essentially becomes part of the property. A basketball hoop, which is affixed to the top of the garage, is essentially part of the property and is thus a fixture. Personal property is divided into two categories, tangible and intangible. Personal property is essentially all property that isn't real property. So, personal property that's tangible can be touched or sensed or moved. So, a rich watch, a car, livestock, animals, tables, furniture, all of those are personal property. Intangible personal property is represented by something else. So, in theory, it might be able to be touched, but only in the sense that it represents something. So, for example, shares of stock are intangible, even if you have the pieces of paper which say that you own them. A checking account. The checkbook itself can be touched, but it only represents the account itself. And also, intellectual property rights, such as copyright, is intangible property. It cannot be touched, but is property because it can be easily transferred. Now, most of you are probably unaware, but there's a number of ways of owning property. It's not just owning property, but how do you own it? There's a number of common forms: joint tenancy, tenancy in common, tenancy by the entirety, and community property. Joint tenancy is where a piece of property is owned by two or more people together with what is known as rights of survivorship, which means if there are two parties that own property and one of them passes away, the decedent's property automatically passes to the other party. In order to do it this way, all tenants must take property at the same time. So, if two people own property as joint tenants and they want to bring in a third owner, the third owner cannot join as a joint tenant. They must become a tenant in common, as do the other two parties. This type of property is not subject to probate and is outside of a will. Tenants in common is a form of joint ownership without any survival rights. So each tenant can pass his or her share to the others at death. Also, the tenants do not need equal shares, whereas in joint tenancy, each tenant had equal rights to the property and to the whole property. A tenant in common, one party may own half of the property, and the other parties may have an interest in only 1/4 each of the property. Tenancy by the entirety is more similar to joint tenancy, except it's exclusive to married couples. It's available in approximately half the states, but unlike joint tenancy, One spouse cannot transfer the property without the permission of the other. It is, however, the safest against creditors. It's a major challenge for a creditor to try to usurp interest in those properties. Community property is not so much a type of ownership as it is a way of holding property in a marriage. So it's exclusive to husbands and wives, but it's also exclusive only to certain jurisdictions. So, for example, almost all of the states east of the Mississippi follow a property ownership scheme known as marital property, and about half of the western states follow the community property model, which was inherited from Spanish law. California, Washington, New Mexico, Arizona, and a number of others follow community property. What this means is that each spouse owns half of all property acquired during the marriage except for separate property. This includes their income. Thus, some interesting scenarios can occur if there isn't appropriate planning. With regards to income, it can also have a very big difference on how things are viewed. For example, in 2008, during the McCain-Obama election, when John McCain released his tax returns, he released his tax return, which was in the status of married filing separately, meaning that the spouses were married, but they filed their own returns. But because he was from Arizona, which is a community property state, half of his wife's income was included in his income on his separate tax return. This is a unique type of ownership, one which is not used in Florida. The most common type of ownership is something called fee simple absolute, which is the broadest estate. There's no restrictions on it. It's freely transferable. It can be used in a will. It survives intestate succession. You can use the property in any way that you want. The only restriction on it is something called eminent domain, which means that the government can take the property with just compensation. However, that is available in all types of property ownership. There's also a type of estate called the life estate, which means that the current owner of the property could be something called a life tenant, which means that they are only allowed to use the property until they pass away or the death of someone else through a concept of pure autre vie. What this means is that the property does not pass with their estate. So, the property that they own and live on, they cannot put in their will, and it will not pass to their heirs through intestate succession. After they pass, the life estate reverts to the grantor. The grantor is the person who transferred the estate to them. So, for example, if you were to give property to your brother Steve for his life, making him a life tenant, after Steve passes away, the property will pass either back to you if you are still alive or to your heirs. Otherwise, the estate can be transferred to someone other than the grantor and his heirs, to the remainderman. So, you could pass the property to someone as a life tenant, and then upon their death, it can transfer to a third party, which could be a charity or some other type of property. Thus, even though the property is owned, it's only owned for a period of time, and that period of time is determined by the life of that person. A tenancy for years is like a life estate, except it's for a specific period of years. So, unlike a lease, the tenant in this particular example has ownership rights, but only for the balance of that term. Thus, you could transfer your estate to someone for a period of, for example, 10 years, and at the end of that 10 years, it would revert back to you. But during that 10-year period, they could use the property as though it were owned by them. There's also assets that are probate and assets that are non-probate assets. So, we discussed joint tenancy. Joint tenancy with rights of survivorship are non-probate assets because the property automatically transfers to the other joint tenant. So, assets that have to pass through probate, which is the court supervised process, are personal property not held in a trust, or real property not held by a trust, or as joint tenants with survival rights. Assets that do not enter probate are things such as life insurance, pay-on-death accounts, living trusts, and joint tenancy. Life insurance is not part of a will in most cases because a beneficiary is designated. Thus, upon the death of a party, the life insurance goes directly to the named beneficiary. It is not part of the estate, but is part of the property of the beneficiary. A pay-on-death account is similar to a checking account, a joint checking account, where when one party dies, the balance of the account simply passes on to the named beneficiary or the co-tenant on that account. A living trust, which we'll discuss substantially later, is a separate entity where property is held that is not part of the estate.